Good afternoon, everyone. Welcome back to my channel. I haven't produced a video in a while, so I took a hiatus. So, uh, before we start, just want to say, remember, past performance does not guarantee future performance, and this is all about investing, dividend investing, how to invest into your investing portfolio as a beginner, and also remember this is for educational purposes only. And also, while we're talking about educational purposes only, like and subscribe to my channel, share this content. Today, we're going to talk about why you shouldn't invest into dividends or uh, produce a dividend portfolio or have a dividend investment strategy. Shame, shame, shame. Do not invest in dividends. Bad boy, bad boy. So today we're going to talk about why you shouldn't and the arguments of what people tend to use to why you shouldn't invest into dividend growth stocks, dividend investing. And I'm going to propose and help you and give you ideas how you can minimize a lot of that, just pretty much the threats of dividend investing. Most importantly, give you a hint. The reason why they say don't invest into dividend investing or dividend growth investing because of taxes. So if you haven't heard it, we'll talk about taxes and how to avoid Uncle Sam, how to either minimize paying taxes on your dividends, or also how to eliminate paying dividends altogether. So if you're excited about this delicious and lovely content, here we go. So as a starter, we're going to talk about the 4 reasons why you should avoid dividend paying stocks. The first reason why is because basically taxable income. When you receive dividends from your dividend paying stocks in your either your dividend portfolio or your just investing portfolio in general, the the dividends are basically extra income, and usually people use the extra income to either reinvest into the actual dividend to grow their portfolio, or they use withdraw the dividend income right out from their portfolio, whether it's in one finance or Fidelity, and use it to pay bills. So what you have to understand is that uh, you have to take it to account that you have to pay taxes on those actual dividends. I know it sucks, right? So one of the number one arguments or like growth investors tend to say, well, don't. Why would I invest to dividends because I'm going to be taxed on it? Where I could just invest to Tesla, and the company is going to reinvest its earnings, and when the stock goes up, I benefit from that because I don't have to sell. That's a great argument, and so typically, right here, as you see, basically dividends, qualified dividends. If you uh, companies like Microsoft, McDonald's, Target, uh, Hasbro, once you buy their stock and you keep their stock for 1 year, the actual dividend is it changes from short term capital gains to long term capital gains, and long term capital gains has a tax rate between 0%, 15%, and 20%, depending on a lot of times also depending on your tax bracket. But uh, receiving dividends is very it's not very tax efficient because as you receive those dividends, it's if you made $50,000 from a job, and let's say you made, I don't know, you build up a portfolio and that's paying you $10,000, $15,000 a year. That $10,000, $15,000 per year is going to be added on to your $50,000 job. So instead of being taxed on $50,000, you're going to be looking around tax time. You have to pay tax on 65,000. So yes, it's but like what they say, it's rich people problem. So, but if you have the money, why not pay the taxes right now? Because then in the future, when you decide to leave your job, rather voluntarily or involuntarily, you can just use the dividends to live off of. So sometimes you have to sacrifice the now for the future, but that's not how some people think, especially when you try to make an argument. The second argument is that you shouldn't invest in dividends because it has a lower share price appreciation. And then here, the number three is the biggest argument is that it takes too long to accumulate wealth. So I have videos in my playlist to show you how to invest in certain stocks to be able to retire sooner, and then use that dividend income, and you can either relocate to, it's called geographic arbitrage. You can relocate to a different scenery that it costs less in terms of cost of living compared to the United States, like Panama, Colombia, Brazil, uh, Singapore, so stuff like that. And so, typically, yes, that's what they say. They normally say when you start out investing, start out younger, try to start out as early as possible. The best time to invest was yesterday, and the second best time to invest is now. And so, yes, dividend investing and receiving those dividends, sometimes it can be discouraging when you only receiving $3 per quarter. But when you reinvest and you keep buying and you stay consistent, that $3 per quarter turns to $20 per quarter, which turns to $50 per quarter, which turns to eventually $150, $500. So it's slow down. It starts slow at the beginning, but then it picks up. The dividend snowball effect. I made a video about that as well. Uh, and lastly, the last thing is that cash flow or ongoing investment. Right here, it says that some people uh, just may not want a cash flow or a cash flow type of dividend strategy or type of strategy. Now, I don't know who doesn't, because the people I know from the area I come around, we love infinite amount of checks. I love when McDonald's pay me $12 per quarter, and when Microsoft pay me $15 per quarter. But if you don't appreciate that, then it's up to you. So right here, we're going to talk about the 10 ways to avoid capital gains tax on stocks that pay dividends. So I gave you the argument why people say that why you shouldn't. And one of the number one argument is taxes. Paying Uncle Sam. When people get their own actual checks, they don't like paying taxes. And so on the actual passive income, they don't want to pay taxes. So I'm going to give you a couple ways to how to avoid how to avoid paying taxes or don't pay taxes at all. Right here, uh, hold your stocks in a qualified retirement account. So basically, you hold your stocks, your dividend paying stocks, either high yields or just your qualified dividend stocks in a qualified retirement account like a IRA or a Roth IRA. So typically, the way to think about it is that a IRA is it's like your 401k. So basically, you you buy the stocks now, you put in the IRA, and you're pushing to pay the tax in the future. The Roth IRA, you pay your taxes on your money right now. So any money that you put in the Roth IRA, it comes out in the future tax free. So one way to either go get around paying taxes or minimize paying taxes is putting your dividend paying stocks in a qualified retirement account, a traditional IRA or a Roth IRA. Uh, Secondly, uh, you can minimize your tax on your income by long-term capital gains rates. Remember, if you choose uh, stocks that are like the dividend aristocrats, stocks that are not BDCs, uh, MLPs, REITs, those are taxed at ordinary income. So REITs like the the monthly dividend paying stock, ABR, AGSC, these REITs, whenever you receive the dividend income or distribution from those, they're going to be taxed at ordinary income, which ordinary income is taxed at whatever your taxable uh, rate is of your income. But but besides that, stocks like again Microsoft, McDonald's, Target, Lowe's, Home Depot, when you receive those dividends and you hold that stock for one full year, then you begin to, the dividends that you receive become tax more favorably. It's because it's called long-term capital gains. And with those long-term capital gains, it shifts from, you having to pay like 20%, 22% to 10%, you know, or 15% or 20%. Also, another way to help to offset taxes is to contribute to donations, and a financial advisor will also be able to help you with that as well. And this right here, number 4, is it's kind of like a joke where if you're dead, and you hold your stocks, theoretically you don't have to pay tax because you're dead. I know that's a sick joke. I know. I'm sorry. And then another key task or tool or technique that investors typically tend to do is uh, practicing tax loss harvesting. Tax loss harvesting basically is that when you sell a stock or a ETF or an investment at a loss, and then once you uh, accrue that loss, if you sell a stock for a profit, it will at the same time it will be a wash. So let's say you sold a stock and you were down $200, but then you sold a particular stock, let's say Texas Instruments, and you sold and you actually had a profit of $200. It will be a wash. That's called basically tax loss harvesting, and you can participate in that. Uh, and then also lastly, so we don't get too far into the rabbit hole, a lot of times to also minimize taxes is that if you live in a no income state, paying a state. So, like for example, uh, these states right here: Alaska, Florida, Nevada, Texas. You don't have to pay income tax on for the state income tax. When I used to live in Wisconsin, I had to pay Wisconsin state tax. Living in Texas, you really don't have to do that, so it helps. And then here, holding your stocks for the long term for 1 year, 5 years, it helps to pay those long term capital gains. And then right here, a lot of times also by creating a business LLC and using that, you can also shelter a lot of the responsibilities and having to pay uh, certain taxes. So it helps with that. Now, since I gave you a couple tools and learning how you can either eliminate taxes or at least minimize it, then the next thing for us to talk about is this. We're going to talk about why I prefer dividend investing over receiving actual wage income. So if you are excited and want to learn and understand why I prefer that, here we go. The reason why I like dividends over wage income, here we go. Uh, I have this article that I wanted to go over as well, to why, no matter dealing with taxes and Uncle Sam, why I prefer dividend income. It's all about how it's taxed. Where for me, I don't mind paying tax. I don't mind if I contribute. If I work, I love reaping what I deserve. And for me, it's all about finding creative ways, like open up an LLC, having a business, real estate. I love, if you understand tax law, you're able to understand how to maneuver through uh, not paying the maximum amount of taxes. And then with here, it's about the same. Earning income through a actual job is the worst way of how to uh, earn a living, but we got to do it right. But I'm going to show you why, uh, how earning $100,000 with dividends trumps earning $100,000 with just income from a job. Actually, $50,000 in dividend income trumps $100,000 and getting paid with at your job. And let me show you how. So if you were to make $100,000 a year from a job, just say you did plumbing, right? You had your own plumbing business. Well, no, not plumbing business. You're a plumber, and you were getting paid $100,000 W-2. You would pay 6.2% in Social Security tax. You pay 1.45% in Medicare tax. You have a normal standard deduction of 12,000, and suppose you earn $100,000 in that salary, uh, you end up you that will put you in the 24% tax bracket. You will owe $15,416 in taxes. So and you ultimately will bring home roughly $76,934. But the magic of dividends, not only just the compound interest, the snowball effect, yada yada yada, buzz terms that we throw out in terms to in regards to dividend investing. But did you know that not only if by buying stocks like McDonald's, Microsoft, uh, what else, Lowe's, Home Depot, by buying those stocks, by holding it for a full year or more, now you are being taxed at long-term capital gains rates, which is either 0%, 15%, 20%. And uh, and then the magic is that if you because the tax bracket has they have increased the threshold. So for 2023, if you make roughly 44,000 in qualified income from qualified dividends, you pay $0 donut, $0 in taxes. Now, uh, but with that right here, go through the same example for dividends. By getting paid your like the dividend income, not only are you are being paid into long term capital gains by holding it for more than a year, but you don't have to pay Medicare, you don't have to pay Social Security. So right then and there, that's a huge benefit over wage income. Why I say you might as well sacrifice now and invest now so that yeah, it sucks to pay the taxes right now on top of your so let's say you're making 50, 55, 60, $65,000 on your job, and you grow a portfolio of let's say 500 to 750,000, paying let's say 25,000 dollars a year. Yeah, it sucks that you're gonna have to pay tax on that $25,000. $25,000. Yeah, it sucks that $25,000 plus your 60,000 is gonna put you as making uh, over $80,000 for that year. Yeah, it sucks, but yes, sucks. You got you eat the cost. You got to pay the cost to be the boss. But when you retire, you're not going to have that 60, $70,000 job that you have to pay taxes to. You'll be paying taxes and you'll be living off your own portfolio. So imagine you grow your portfolio that's paying you 20,000 a year to 40, 50,000 a year. You don't have a regular job anymore. So now only thing you have to do is pay taxes on your dividend income. And remember, if you keep your dividends for more than a year, it's long term capital gains rates, and then anything under 44,500, you pay zero taxes. And then we have in America, the United States, we have a step up in terms of step up bracket in terms of levels of you paying taxes. And so uh, this is the cheat code: dividend income and investing in either receiving dividends or actually buying an investment like Tesla or your index fund, letting it grow, keeping it for a long term, and selling it and reaping the rewards for only having to pay long term capital gains rates. It's the cheat code, and it also helps you if you have a business as well, and then you have real estate because then you can apply depreciation on the real estate, and then you have a business and you get all the tax breaks of writing things off, having a business, having an LLC. So I know I said a lot, but you just know that it helps to basically dividend income. I love dividend income. I know I gave you guys reasons why people have arguments of why you should be a dividend growth investor, why you shouldn't do it because of the taxes and Uncle Sam and the boogeyman. You got to pay taxes, but hey, when you live in America, you find ways to pay less taxes, and then guess what? Boom. Lastly, the last thing is that the Roth IRA. So with the Roth IRA, uh, you're able to take advantage of the being able to grow all your investments, whether you buy Tesla, ETFs, index funds, on a tax-free basis. So basically, you able to put your money into this taxes advantage tax shelter account, and then you put whatever type of stocks you want. You can put growth stocks like Tesla. You put income stocks like Jeppy. You can put growth stocks like Blue Cross Blue Shield and AutoZone. Uh, income stocks like Arbor Really Trust, and you just buy it per month, and then you can, little did you know, you will have a portfolio that's $100,000, $450,000 per year, and then you even maybe have a portfolio of $750,000, and most importantly, it's tax free. That's why the government only allow you to even put in a certain amount of money into the Roth IRA, because it's a cheat code. Cheat code. The first cheat code is dividend investing, keeping it for over the year, long term capital gains rates. And then the second cheat code is that if you take that and you put it into the Roth IRA, it's double long term capital gains rate, and then put it into the Roth. Anything you put it into the Roth. You know what I'm saying? Years later, you take it out, it's going to be tax free. But also remember, you have to be at age 59 and a half to be able to take money out, Roth. So, but then there's also some key things like tricks in terms of with the Roth. Um, Whatever money that you put into the Roth, you can take out, but any gains or increases, you're not able to take that out. It's just certain rules that you have to follow by with the Roth. But just know that you put money into the Roth. The Roth is a tax shelter account. You put money into it, you grow your account, you grow, and then years later, 10, 15, 20 years later, once you have this huge portfolio, you're able to take money out your account tax free. So just know that yes, taxes are bad. Yes, I gave you reasons why people argue to maybe you should do growth investing over dividend investing. But guess what? I am a dividend growth investor, which means that I buy stocks that grow, companies that are profitable and that grow. And if you agree, like and subscribe. If you don't agree, like and subscribe. And hope you guys enjoy your day.